One of the more common types of corporate actions is a stock split. The issuers of underlying stock may decide to split their stock by either increasing the number of shares available through a forward stock split or reducing that number through a reverse stock split. The impact on shareholders is that after a certain date, they will either own more shares but at a proportionally lower price for a forward stock split, or fewer shares but at a proportionally higher price for a reverse stock split. There are numerous reasons corporations may declare stock splits. In a forward split, the motivation for lowering the stock price might be to stimulate trading activity. Lower stock prices can also make it affordable for more investors to purchase round lots of shares, or 100 share blocks, which help facilitate bookkeeping for the corporation issuing the stock. Whatever the specific reason, forward stock splits generally reflect the company's optimism about future earnings and growth. Conversely, a reverse stock split is intended to increase the share price of the underlying equity while simultaneously reducing the number of outstanding shares available in the market. A common reason for doing this is to maintain a minimum share price in accordance with equity exchange listing requirements. If a company fails to maintain a minimum share price, it might be at risk of their shares being delisted from a national exchange. Regardless of the reason, both forward and reverse splits aim to maintain the position's aggregate value. As an example, if an investor held 100 shares of stock, which is trading for $500 pre-split, the position would be worth $50,000. If the company announced a 5-for-1 forward stock split, the investor's 100 shares would increase to 500. The share price would be proportionally reduced to 100, and the investor would still hold the same $50,000 worth of stock at the effective time of the stock split. Or the investor might own 500 shares of a company stock that is only trading for 20 cents per share, and therefore owns $100 worth of stock. If the company enacted a reverse 1-for-10 split, the 500 shares become 50, and the 20-cent share price increases to $2, though still maintaining the same $100 valuation. In either case, the aggregate value of the stock position remains the same post-split as it did pre-split. The overall effect is similar to getting change for a $5 bill at the moment the stock split is effective. Before you get change, you have one note worth $5. And after you receive change, you will have 5 $1 notes. The difference is only the value of each note. The aggregate value is the same $5. However, as soon as a stock split is effective, the value of the shares may change due to market valuation, as would be the case with any stock. In a reverse stock split, whole shares are exchanged for a lesser number of shares in proportion to the split ratio. In other words, a reverse stock split results in a post-split stock price proportionately higher than pre-split, and with the stockholder owning fewer shares after the split than before. As a reverse stock split is intended to boost the share price by the ratio of the split, it is often utilized by companies whose share prices fall below the exchange minimum share price requirement for continued listing. Owning 100 shares at $1 is the economic equivalent to owning 10 shares at $10. Therefore, the result of a reverse stock split is a post-split stock price higher than the pre-split price, with a stockholder owning fewer shares after the split than before. Historically, adjustments made to contracts after a reverse stock split have included a decrease to the unit of trade and a change to the option's symbol to contain a numerical suffix like XYZ1. However, adjustments are historically not made to the number of contracts in an investor's account, the contract strike prices, or the contract multiplier. Let's look at a hypothetical example. In recent months, Share prices of XYZ stock have declined significantly to $1 a share, and now, at risk of violating the minimum pricing requirements set by the equity exchanges for listing, to maintain listing status, XYZ announces a 1-for-10 reverse stock split, and upon the effective date of the split, shares open for trading at the split-adjusted price of $10. The split results in shareholders exchanging 10 of their shares held for a single share of XYZ, though at a share price 10 times that of the pre-split price. To accommodate this change, options contracts that previously delivered 100 shares have historically been adjusted to call for the receipt or delivery of 10 post-split shares per contract in the event of exercise and assignment. Aside from the adjusted deliverable, the trading symbol also changes from XYZ to XYZ1, with the numerical suffix indicating that the contract is an adjusted option. However, no other changes would be made as the number of contracts, contract strike price, and contract multiplier all remain the same. Additionally, nothing changes from an economic perspective at the effective time of the reverse split either. As the price of the stock increases by a factor of 10 on the effective date of the split, the options deliverable would be reduced by a factor of 10 as well. If an investor purchased an XYZ January $5 call prior to the reverse split, upon the effective date of the change, they would find themselves long one XYZ1 January $5 call with a new deliverable of 10 shares per contract, down from the original 100 shares. In the event of exercise, the investor would pay their strike price times 100 and take delivery of 10 shares of XYZ stock. Prior to the split, the January $5 calls are out of the money by $4, as the $5 strike is $4 higher than the underlying share price of $1. After the split, the shares will be trading for 10, but the $5 calls are still considered out of the money, as the adjusted XYZ1 options now deliver just 10 shares of XYZ rather than the standard 100. To illustrate, if the investor were to exercise the standard XYZ $5 call pre-split, they would pay their strike price times 100 or $500 and receive 100 shares of XYZ stock valued at $100. Hence, the out-of-the-money status of the call. Post-split, the investor would still pay $500 to exercise, but now receives only 10 shares of stock, now trading at $10 per share. Though the share price has increased by the factor of the split, 10 shares at $10 has the same value as 100 shares at $1 at the effective time of the split. Consequently, the adjusted call contract is still out of the money, even though the post-split share price is higher than the strike price of the call. In order for the newly adjusted call to be considered in the money, the post-split value of 10 shares must be greater than the aggregate exercise value of the option, as the investor would be required to pay the strike price times 100 to exercise, or $500 in this example. The value of the deliverable must be greater than $500 to be considered in the money. As the deliverable now contains 10 shares only, the $500 exercise value equates to a purchase price of $50 per share, meaning that the post-split price of XYZ must be greater than $50 per share in order for the adjusted $5 call to be in the money.